Hi, this is Keith Schneider, CEO of MarketGauge.com. This is September 15th, 2013 edition of Market Outlook. Don't forget to sign up for this free newsletter and video recording for market analysis every week. So, without further ado, let's get into the markets here. We got some interesting cross currents, and we're going to get into those. We're going to cover the usual fare of the stocks, S&Ps, volatility, the market indicators, and we're going to look at some rather unique things like the rate of change on interest rates, which is the key component that we're going to be looking at. And a lot of people have been talking about the 1987 parallels, about how the market is behaving, and we're going to take a quick look at that as well. So first thing, spiders, what's happening here? Well, for one, you can see that we have, as we've noted, accelerating 50-day moving average to the upside, the 200-day as well. You can see that we're sort of trading now outside of this channel. There's a couple interpretations to the channel, but essentially we're trading on the outside of it and holding it pretty well. But the key thing is that the momentum is still clearly to the upside. Now, on a shorter term basis, we have inside days. So what's important to note here is a breakout of the inside day. You've got a lot of compression over here over the last couple of days. I mean, the market has essentially climbed higher in the spiders, but nonetheless, these last 3 days, if we can blast through here, it would probably at least take us to the test of the highs. Now, also to note that we have 1, 2, 3 accumulation days over the last couple of weeks. So that's pretty positive, and really no distribution days. Well, we did have one late August. So over the last couple of weeks, certainly institutions look like that they've been adding to their positions or accumulating. At this point, we're neither overbought nor oversold. So, in overall view, we're looking relatively decent. Let's take a look at the VIX. VIX corresponding to the price action in the S&P directly. You can see that the 50-day is under the 200 and we're sitting right here. So things are clearly improving from a sentiment situation, because we're at the midpoint of the Bollinger Bands. The 50 is now turned under the 200-day. We're trading right around the 50-day moving average. So sentiment has been steady, neither frothy in either direction. So that's relatively positive, considering that the moving averages are slope negative and we're basically at or below both of them. So overall picture on sentiment positive. Let's take a look at the market indicators. Well, as you can see, what you have here is the McClellan oscillator, which is looking out about a week to 3 weeks or so. The McClellan clearly generated what looks like a sell signal, right? We got to overbought readings and are now hooking down. Now, it's possible, and what has happened in a bull market is that there was another thrust up. So we certainly want to thrust up in these overbought areas. When we got the sell signal, it either went sideways, got a thrust up, but overall it's an early warning indicator. Now, it works extremely well when both the McClellan, which looks at 1 to 3 week time frame, gets confirmed by both a sell signal in the advanced decline 10-day and the up down volume. So we're not there quite yet. That really improves the timing both on an intermediate and a shorter term basis. So at this point, even though we've hooked down, we have not crossed down under the key points here, which is 60 on the up down volume ratio and 2000 on advanced decline. So even though we're in this higher region, we really have to hook down, and that would be a much more clearer signal. So I would say on the market internals, getting a bit rich. Any significant sideways action in the market or any downward action, I think, would trigger a sell signal. However, if we take out the highs here, obviously things can get overbought for a long period of time and stay overbought, and that is not uncommon, and so in a bull market, and that's certainly where we are. Let's take a look at the TLTs, bonds. As you can see, interesting pattern here. The bonds clearly in a bearish phase. However, we do have a potential double bottom. You do have a slingshot pattern which is still intact, and so lots of sideways action. A test of the 102 area early last week yielded a pretty nice size bounce, and we're still playing this out. If we can get above 104, very interesting. Probably means that this bottom here, at least temporarily, is in place, and you get a rally at least to the 106 level, or possibly even turn this around. And that would be an indication that the market, the interest rates, have run ahead of itself and anticipating tapering. Let's take a look at GLD, gold. Okay, gold clearly back down into a bearish phase, although the 50-day moving average is pointing up. We had that inside day, a gap down, and I'm going to show you a trend line that was violated. This is a fairly significant trend line from the lows here, and you can see basically we violated the trend line and back into a bearish phase. And again, we do want to be on the lookout for a return move back over the inclining 50-day moving average, which would put it back inside the Bollinger Bands. Now, Friday's action was interesting because you sort of had a follow-through flush move on Friday and yet closed on the highs of the day. So short-term price action indicates potential exhaustion, or on the downside, right? Don't forget the market's moved down $100 since late August in gold bullion, and that could be a potential sign of exhaustion, especially as you can see we hit oversold on the RSI as well. So we want to be cautious here. The trend still clearly bearish in gold, however, showing some signs of exhaustion on the downside. So potential temporary pause. Also, let's be on the lookout for a potential move back over the 50 and back into the channel and back above the lower end of the Bollinger Band. That would indicate that this 100-point down move has exhausted itself. Okay, let's take a look at one stock that is also of interest before I get into interest rates in a little bit more detail. Intel had a pretty significant breakout on Friday on really good volume. You can see here that the volume was almost 60 million shares, not quite double what the average daily volume has been. But more importantly, you can see we tested the 200-day. We're now trading decisively above the declining 50. I'd like to see another close over that 50, confirming a bullish phase for this particular stock. And this Intel has certainly been a laggard, so this is interesting price action right here. If we take a look at the monthly chart as well, another interesting conversion, which is we basically tested the 80-month and the shorter term monthly moving average as well and closed above it. And if we move to the weekly charts, also a similar pattern, right? We have the 200 weekly moving average and the 65. We closed above those key moving averages. So all the moving averages are converging and we're breaking out above it. So if we can sustain it, we can certainly see a nice 10 to 15% move, at least a move from 23.5 to 26. And if the bigger pattern plays out in Intel, I mean, let's just go back here into the monthly chart, and you can see that we have basically been going through sideways action. So we do have a potential for a move back up to this bigger channel line. You can see I took a parallel from the lows back in 2007, 2008, drew a parallel to the highs that were back in early 2003, 2004, and that comes into the 32 area. So that's a pretty decent sized move if this plays out. So for those who are playing longer term, Intel might offer a longer term play here as well. Now, one of the things that people have been very concerned about, and especially a lot of the more negative people have been looking at the rate of change, which is over the last 12 months of interest rates. So if we take a look at the 10-year Treasury note, this is something that goes back to 1980. And you can see the middle chart here is the 12-month rate of change. And you can see going back over 30 years that the recent rate of change, right here, this is a 75% number. The rate of change on an annual basis is the highest it's ever been. And obviously, if you look at the crash going back in 1987, you can see that the rate of change hit around the 30 level, and the market, and this chart here is the Dow Jones going back on a monthly basis back to 1980, and you can see what's happened every time you get a severe rise in rates, right? A lot of people think you get an immediate reaction to a rise in interest rates, but that doesn't always occur. Oftentimes, as you get a rise in rates, there's often a lag or no response or very muted response from the equities market as higher rates suck money out of the market. And in this particular case, you can see we've continued to move higher. So, looking at, number one, the long-term move in rates, right, you can see that rates have been trending down, but we're also at the higher end. I mean, you can see that this is pretty much this moving average here, this line right here has been sort of a demarcation zone. Things haven't really gotten much higher than this, and again, we're approaching the top end of it. So we definitely want to continue to watch this rate of change here. It looks like it might be abating. Now, one big difference between where we were in 1987 that everybody's pointing out to is that TNX, which is the 10-year Treasury note, in 1987 was trading at about 90. Okay? Right? And in this right now, it's trading at 29. So interest rates are significantly lower than they were in 1987. So, when you look and try to measure some of these long-term gauges, you want to think about things on a rate of change basis and absolute basis as well. Nonetheless, we definitely want to keep track of this rate of change in the bonds. We took a look at the TLTs. It's possible that, when you look at this monthly chart, that the potential double bottom in the TLTs are sort of corresponding to this peak move here and against this really long-term downtrend in interest rates. So we want to watch that. Now, if we rally in the TLTs and rates sort of abate and that the anticipation of the tapering is already in the market, that will play out in the TLTs. We start moving about 104, and that may negate any massive sell-off in the market. But we definitely want to be cautious, because if you look at the pattern here, whenever you get this type of rate of change in bonds, the market has certainly had a muted move to the upside, and has also precipitated a couple very significant declines, and certainly stalled the market at the higher levels, right? So you can see right here, right, back in 2000, which was where the market started to peak, the Dow basically went flat as interest rates and the rate of change sort of peaked out. So it took all that time to digest this, but the market basically went sideways, right? Same type of action back in the mid 90s. You got a significant rate of change in interest rates, and the market went sideways for almost a year. And in 1987, I don't have to tell you what happened there. So let's take a, keep an eye on that rate of change. And again, watching the market phase in the spiders and in the Dow is going to give you a clue. So as we start moving towards the month of October, we definitely want to keep an eye out on these things, as anything is possible. But we're not going to second guess. We'll let the market tell us. We're going to look at the short-term structure of the market as well as the market phases, and keep track of this rate of change. So anyway, hope this was helpful. See you next week. And again, don't forget to sign up for this free newsletter, and see you next week.